What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some stock analysis for Meta Platforms. This has been one of my favorite stocks, really, since I've started investing 7 years ago. And this one, I've had some crazy runs with. I've made a whole lot of money on this one, and I haven't really lost money, but I have missed out on money, I guess you could say. So right now, I only have one share because I'm pretty much just holding that so I can keep an eye on it because I really went back into the stock. I sold out of this stock at, I believe, I sold most of my shares at around 350, and then I think I sold my final share at around 600 or something. So I really want back into this company, but it has to be at the right valuation, and that's why I'm watching it. Because now that the market is crashing, hopefully we get a good buying opportunity here. But let's look through these numbers. So Meta Platforms is a $1.5 trillion company. And we have a very strong revenue chart, as you might imagine. Last 5 years, they're growing 18% on average. And the next 2 years, we have 14 and around 14% revenue growth expected. Net income, a little bit more choppy, but still good, averaging 27% growth the last 5 years. Overall, pretty solid though. Last year, they did $62 billion of net income, which is insane to think about. And cash to debt ratio is not horrible, but it sure got a lot worse last year. Look at the debt go from nothing up to $47 billion. And that's probably one of the big reasons why the stock crashed so much. Back when they announced that they were going to be spending all that on, you know, AI, not AI, but mostly metaverse stuff and some artificial intelligence stuff. So again, I don't know. That's not optimal for them to have that much debt, but it's not horrible. It's as long as I mean, it's not more debt than they have cash, so it's not that bad. Return on capital employed, 29%. Very strong, very solid there. Then we go to shares outstanding, pretty much trending down, so that's good. Dividends, I guess they're paying a dividend now. I don't think it's, yeah, I don't think, yeah, I guess it's a 0.3% dividend, 8% payout ratio. I don't know. That's not anything to really focus on. But EPS estimates, we got about 23 bucks was EPS for last year. This year it should be 25. And the following year should be up to around $29 EPS. And Meta is one of those companies where, they own Facebook and Instagram, and there's billions of people on their sites. And I remember when this stock was $100, last time it was $100 a couple of years ago. I remember making TikToks about it and people saying, "Oh, this stock is definitely going down. They're done. Nobody watches it. TikTok's going to run them out of business." All this stuff. Of course, that did not happen. So I think those platforms are examples of platforms where when you got 3 billion people using your sites and so much stuff, businesses, so much stuff are established with those sites. Yes, it's possible maybe one day in the future for those brands to be irrelevant, but I don't think it's going to be anytime soon. I don't think it's going to be the next 5 years. I think it's a long time away. So that's why I think they have a special moat that is not, it's pretty much no company can recreate that right now. That's almost impossible. I mean, TikTok got close. TikTok got a billion users pretty quickly, and they have a whole lot of attention on their platform, and their algorithm and everything is pretty sophisticated, and it definitely can compete with a company like Meta, but it's still, you don't have 3.5 billion people on your platforms. The other thing is I've been talking about this with certain people about how the way they control the ads, and you're almost forced to spend money with them. You're almost stuck. If you want to grow as a creator, or if you want to have people see your content, they kind of control whether or not, how much attention you get, how much business you get, all that stuff. So that's another thing where it's like they have a lot of power with what they have right now, and that's why it's a good stock to own. The interesting thing is this stock has never traded at insane valuations. Look at the last 5 years. The highest it's been is pretty much in the low 30, or yeah, low 30s, 33 or so. And when we had our little crash 2, 3 years ago, it traded down to 13 times earnings, which is insanely cheap. But right now, we're right in the average. We're right where we should be pretty much. And this is roughly, this is healthy territory. This is right in the middle here. So I wouldn't say it's a bad time to buy. I think you can make money with this. I mean, the stock keeps trading at 25 times earnings, which is pretty much where it keeps, mean reversion. It keeps wanting to go back to this mean of about 25 times. So as long as, let's see, we got 25 times 25, 625, the stock should be this year, which we're right around there, which means again, the stock is almost fairly valued. And then going into next year, the stock should be 725 bucks. So really, I wouldn't say there's not a lot of money to be made right now. Um, I'd want the stock at 500 bucks. I definitely would probably buy at least one share if it hit 550. But if it hit 500 bucks, then I'd buy a couple shares. And then you're looking at a good, I want to be able to make at least 25% on my money. And so that's kind of the way I look at it. But the numbers are strong, the moat, the competitive advantages are strong, and the valuation is fair right now. Now, their EPS is going up. So you can make money just off of that, right? And you might get lucky. You might, going into next year, let's say earnings climb 10% or whatever, and let's say investors value this at a higher ratio. Now it trades at 28 times earnings or 30 times earnings. Well, sure, then you're going to make more money. But that's if that happens. The stock could also go down to 20 times earnings and then you lose. So, and that's really what I wanted. I wanted at 20 times earnings. Who I might not get it. This stock could keep trading at this valuation. So I don't know. It's interesting. I kind of wanted to buy more, but I really would just feel better if it was around 550 or 500 because then, I have a much better chance of making a lot more money. I'm gonna make more money. If I'm buying it at 6 or 620, I'm not gonna make, I might make 15% or something, maybe 20%, but I want to make I want to make 30% plus or something. So that's kind of the way I look at Meta. I think it's a great stock to own. I just think if you want to make a good amount of money with it, you got to buy it at the right valuation. And right now, I don't think it's at as cheap of a valuation as it should be if you're looking to make, 30% plus on those shares. So thank you for watching. I will see you in the next video. And if there's any stocks you want me to talk about more or do analysis on, let me know down below and I will do that. Catch you in the next video.